Hi, welcome to our new segment at Move Smartly, what we're going to call the Real Estate Roundtable for now. We're going to be looking at Toronto and Vancouver housing markets from our intrepid experts, John Pasalis, housing analyst and realtor, president of Velocity Realty in Toronto, and Steve Saretsky, housing analyst and realtor, head of the Saretsky Group at Oakland Realty in Vancouver. Hi.
Thanks for having us on. This is John, obviously, we chatted about putting this together. So thanks so much for doing that. And a special shout out, I think we should have a special shout out to Jesse Baines, who RIP, we had a good run at Yahoo, but he obviously left. So there was so much good feedback that we wanted to continue the show. And obviously thanks to John or me here for helping coordinate this.
Yeah, looking forward to it, and I agree. It was a great run, and I personally, even though we're in the market and we chat all the time on Twitter, it's like I enjoy doing these discussions once every 3-4 weeks. So looking forward to kind of sharing that with everybody.
Yeah, so just to kind of confirm here for the listeners, so the plan here, I think, is we're going to do this once a month, basically. So we'll put on a show of Vancouver and Toronto markets, basically. So
exactly.
Excellent. Yes. And thank you to Jesse. I believe he's still living.
Yeah, he's in good health. From what I know,
he's in good health, but big shoes to fill. And yes, the popularity of the segment you could see by the number of views and the great questions that you were getting and we got for today's segment too. So glad to be able to continue that here at Move Smartly. So let's just start with an on-the-ground check-in. What's happening in Toronto and Vancouver. And of course, the story is a different one for the first time in a very long time, falling sales and prices. So John, in a recent Twitter post, you noted that home sales in May are the lowest that they've been in 20 years, barring what we saw in 2020 during the first COVID lockdown. And that average prices for low-rise houses are down $200K since February. So are you seeing these trends evenly across the Toronto area? Are you seeing differences between houses and condos?
Yeah, very different trends across the GTA. Certainly the suburban market's getting hit the most. Both the low-rise suburban market and the condominium suburban market are seeing a bigger slowdown and bigger price declines than sort of the downtown market. So suburbs are probably down, I don't know, maybe 15% or something like that, whereas downtown might be down about 5%. And a lot of this slowdown is, really that statistic. We're at the lowest level in 20 years. This is just buyers pulling out of the market. It's not like 2017 where buyers pulled out and we saw a flood of listings. Listings are relatively normal, but it's really buyers exiting the market, hitting pause. Sellers are getting very few showings, and that's putting pressure on prices for people who already bought and need to sell their home.
And what's the mood like generally amongst buyers, sellers? What are you hearing?
I think buyers are a little nervous and cautious. Some of them who need to buy obviously are trying to find value, but there's so much uncertainty. You have other buyers saying, why don't I just wait, and see what happens in the fall. So I think that's one of the reasons why we're seeing a lot less activity. Some buyers just saying, I'm going to wait a few months just to see what the market looks like in September.
And Steve, turning to Vancouver, I found a recent tweet that you had about suburban sales very helpful. You noted they were coming down over 50% since last year and that prices were also adjusting in reaction. What are you seeing again across the Vancouver area? Is there a difference between the core and the suburbs? And again, between that houses and condo segment?
Yeah, no, it's a good question. It's funny. I have a lot of clients that are obviously, pay attention closely to the news cycle and to our tweets there. So I think they're seeing, a lot of the sort of really sounds like almost like horror stories of what's happening in the GTA, or at least in the suburbs of the GTA. But I don't think it hasn't been as drastic here. We're definitely going through a significant slowdown, but we're not seeing I know there's people who've been talking about, all these appraisals are not coming in at what they should be. I haven't really seen that in Vancouver, but what we are seeing is a drastic slowdown, particularly in certain segments of the market. So yeah, if you look at the Fraser Valley, which is basically our suburban market, that was where most of the growth happened during the pandemic, right? Everybody working from home. So these suburban markets, the Fraser Valley, home sales were down 54% year over year. So, you've had volumes cut in half. I get it that they're coming off of record highs, but this is that's drastic to have your volumes cut in half. And that's again, I still think fairly on in the correction here. So on the sort of the flip side, we're still seeing quite a bit of strength for some entry level product in the condo market, particularly stuff that's in the inner city here. So, if you're coming into the city of Vancouver, into the core, these 1-bedroom condos or these really small 2-bedroom condos are actually still, a lot of them are still getting, like, there's a lot of multiple offers happening. So that segment is still actually quite tight. Where you're seeing all the weakness and sort of the doom and gloom is actually from these pretty substantial declines in sales volumes in the valley plus price decline. So we've got like the typical house or townhouse, which was the most popular product, I would say, is down anywhere from, relatively conservatively, you're looking at a 10 to 15% decline from the all-time highs in February. So it's been a pretty significant price shift. But I always like to say as well, like, I feel like that price, John, maybe this is something that you can touch on there, but like, I feel like the prices in February were kind of like fictitious. Like they weren't like real values. It was just like people were just making up numbers. So yes, we're coming off 10 to 15% off those really crazy highs. And so it'll be interesting to see obviously where things go, over the next 4 to 6 months.
I mean, you're right. They were insane prices. And the crazy thing is, 10 to 15%, I looked at it, really just puts us back to October prices, which, it's not even like we're basically just shed a few months of price appreciation. That's how insane the market was between, the last quarter of 2021 to the first quarter of this year, or the first 2 months of this year. So
yeah, you had a good tweet, actually. I saw it today. It was you put out a Twitter poll, and it said, to get back to pre-pandemic prices, the national home price index had to fall something, 36%.
Yeah.
And it seems like it was kind of a split vote on whether we would get there or not. So yeah, pretty interesting. 36% nationally would be a crisis in my opinion, but.
Well, yeah, I think the US housing market during the financial crisis and their bubble, I think nationally prices fell like 27%. So
was that it? 27?
I believe, yeah. And certainly some of the markets, like the bubble markets, were like 40 to 50, but nationally, I'm pretty sure, like if you look at the Case-Shiller index, I think it was around 27, 28%, something like that.
Yeah. So you had like was it like the Sun Belt, where like Vegas came off 40 to 50. And then I think Seattle was only like 15, 20% or something. Yeah.
And again, that variability between areas seems to be the key. It sounds like, John, the numbers that Steve's mentioning around the suburbs in Vancouver, a drop of up to 15%, that is commensurate with what you noted in the GTA suburbs. Some areas see even 20% drops.
Yeah, very similar trends. Interestingly enough, again, it's interesting how Toronto and Vancouver seem to follow each other very closely. We've kind of noted that even the past couple of years in our segments, and very similar dynamic for sure.
Now, one interesting difference, which we just were touching on in our pre-chat, is the months of inventory indicators. So normally we look at that to see, if every house on the market sold, how many months if they all sold immediately, how many months would it take? And there's a little bit of a difference between the markets. And we just found that's kind of interesting. So John, can you talk a little bit about where months of inventory are for Toronto and what that says to you? And then Steve, we'll hear about the Vancouver side.
So we were at a low of, I think, around half a month of inventory back in February, which is, just insane. It just means that if no other homes got listed, we'd run out of homes in like 2 weeks, which is crazy. We've come up to 2 months of inventory now, which on paper is still a seller's market, and this is where I think a lot of agents in Toronto are confused. They're looking at that number and thinking, oh my God, it's still a seller's market. Prices shouldn't be falling, but they are falling, and they're falling, at least from my perspective, because demand's plummeting. You have a lot of sellers who needs to sell because they bought, and those are effectively distressed sellers. Like when you're bound to another contract, and if you don't close on it, you're going to lose hundreds of thousands of dollars. You're in many ways distressed, and those sellers are basically taking lower prices so that they close on the home that they just bought. And that's what I see, one of the main reasons why prices are falling. Even though technically on paper, we're still a seller's market, I think that's really what's kind of causing the slowdown right now.
And Steve?
Yeah, I think that, it's important to sort of make a distinction here, but Vancouver typically has a higher months of inventory than the GTA. I mean, that's based on our conversations between John and I here. So for example, months of inventory for single family houses in Greater Vancouver here. I mean, we hit a low of, I'm just looking right now, we had a low actually in March of 2021 of 1.9 months of inventory. And most recently in March of 2022 was about 2.6. So that's kind of like your lows is kind of around, we get to around 2 in a very hot bull market. So we're now back up to about 5.2 months of inventory. So I mean, at 5 months of inventory for a single family house in Greater Vancouver, that's indicating that downwards pressure on pricing. It's a matter of if that's going to hold. I mean, if we go from 5.2 back down to 3, then the correction might be over. I think obviously my opinion is that we'll probably moderate here in the 5s, and that will, as long as that moderates in the 5s, that's going to indicate downwards pressure on pricing in the near term. So that's kind of my view. But again, if we kind of unpack things a little bit further, because we single family houses in Vancouver would be $3, $4, $5 million. So I always say, like, well, now if you're a particular buyer that's looking for a house, let's say in Vancouver under 2 million, which is the most market participants are trying to squeeze into that single family market, which means a house under $2 million, there's about 3.5 months of inventory, which is up from about 1.5. So we went from a really tight market to 3.5 is fairly balanced. But like to John's point, like everyone's like, well, 3.5, like how come we're seeing price declines? Like we're seeing houses that were trading at 1.7, all of a sudden they're going for 1.5. Why is that happening? And I think it is a case of like, there's a few people that were caught offside, people that, they already committed to purchasing a new house back in February when the market was ripping hot. And they're like, oh, well, it shouldn't be a problem for me to sell my house, no problem. And so they go list it here in April and all of a sudden they can't sell. So, I was in a showing the other day and like, this realtor is like, this house has already taken like 2 price reductions. And the realtor is like, oh yeah, well, so they've already bought a house, they've relocated. And I was like, oh yes, please tell me more. Like, like, they're going to use that to my buyer's advantage, obviously. So there are people that I think are going to be stuck in that situation where all of a sudden they own 2 homes and they're in a bit of a panic to sell. And so they're unfortunately the subject of lowball offers.
Yeah, it is really sad to hear about some of those stories. The people that are caught in the sudden changes are obviously the people that are, the ones most affected. John, you always remind us at Move Smartly that the months of inventory indicator is kind of like tells you a lot about momentum and sudden momentum shifts. Sometimes it's that momentum shifting that can really catch certain buyers and sellers out, right? So moving on to the second most interesting story in Canadian real estate, falling prices it's always going to be the first, is rising interest rates. So at the start of the year, Scotiabank seemed like one of the boldest banks for coming out and suggesting that we would see 7 to 8 quarter point rate hikes by the end of this year. Many thought that was probably unlikely, but given that the Bank of Canada has just raised its policy by 2 quarter points, raising our variable mortgage rates again, and the bond market has reacted to the hawkish statement that accompanied the bank's movement, indicating that future rate hikes are coming. So the bond market's reaction has resulted in fixed rates going up again. It seems like we are well into that territory of being on track to see 7 to 8 points quarter increases by the end of July. Now, Steve, late last year, you suggested that seeing this kind of magnitude of increases would be like seeing the rug being pulled out from under us, because of course, Tiff Macklem, the Bank of Canada governor, told us to go out and spend, and we didn't have to worry about a thing. Looks like that rug is being pulled. So I'm wondering what you think or why you think many thought that would be unlikely and what's changed.
Yeah, no, I'm happy to be the brunt of all criticism here. I'll be the first to admit that that call, I said rates wouldn't go up. I think I said 3 to 4 hikes, and so what are we at now? 5, and we'll get another 50 basis points here. So Scotiabank's obviously looking right from that angle. I will say that Scotiabank also said house prices would not decline So I think they're already wrong on that angle. My whole viewpoint was always, again, I think when the data changes, we always have to change with that, right? So I think at the beginning of that call, it was kind of like, what was it, November, December, like all of a sudden Ukraine, Russia invades Ukraine in February, and you lose, one of the second largest commodity exporters. So all of a sudden you've got oil prices ripping higher, and all these other shortages, which are creating more inflationary pressures. So inflation should have probably rolled over in Q1. Obviously, that's being prolonged. So that certainly, I think when the facts change, you have to change your mind. But at the end of the day, I still think this is setting up to be, I think, a disaster, because I just think that central banks are trying to fight inflation. And I don't think this is the inflation that you can fix necessarily by raising interest rates. They can't print more oil, they can't print more food. And so, I think what we're seeing is basically the housing market in Vancouver and GTA is not built for mortgage rates at 4.5%, 5%. And we're seeing, like, to John's point, right, a 20-year low in home sales in May. I mean, that's why I think, like, again, the Bank of Canada has to do what they're going to do. They have to sort of talk up a big game. I still think they're not going to get as far as everybody's expecting. The market right now is pricing in an overnight rate of 3% by the end of the year, which would put the variable mortgage, John, at what, 4.5%?
Close to that, yeah. Because
again, 4.5%. I just don't see it. Again, I think that the housing market is going to fall further, and at some point we're not going to be talking about inflation. We'll be talking about financial stability, because when real estate is, I didn't build the economy, but real estate is basically the driver of the Canadian economy. That 10% of the workforce is in construction alone. So yeah, anyways, that's my long-winded answer. Is I think that rates are going up, inflation's been stickier than everybody expected, and I still don't think they're going to get as far as they are. But Scotia's call on 8 rate hikes will perhaps be right for the wrong reason.
Did they know something about geopolitics we didn't? John, your thoughts?
I mean, and Steve's right. I think most economists didn't agree with Scotia at the time. I mean, I think most people were not expecting that many hikes. And I kind of tend to agree with Steve. I don't know if they're going to go as aggressive. I think the challenge the bank's going to find themselves is, we're an interesting time because, sales are plummeting, prices are plummeting. They've only raised the equivalent of like 5 quarter points in the past 3 months or so. They say it takes 12 to 18 months for us to fully feel the effect of higher rates. So we're not even close to feeling the effect of higher rates, and the market's still slowing down. And my instinct is, and this is what makes the market so hard to predict, and Steve's right, I had this poll about how low will prices go. I think the challenge is, I think the bank's going to find themselves in this situation where they got to choose between trying to prevent a further decline in house prices, but because increasing rates rapidly is going to do that, versus trying to kill inflation, right? And I think that's the tension, and probably why they're not going to go up to say 3%, because doing that will crush the housing market. And Steve's right, you cannot go from variable rates at like low 1% to over 4% within 12 months without doing some serious damage to the housing market. Like, it's not, he's right, it's not built for that level. It's not built for that drastic a change. And I think that's what's making sort of the next 6 to 9 months difficult to kind of predict what the outcome's going to be. So
I think it's an important distinction, because everyone's like, oh, like we want, like it should be healthy, we need to get rates back into a healthy level. It's like, well, it is what it is. Like, at the end of the day, like if policymakers see, national house prices down 15%, like right or wrong, like they I think history has shown us they hit pause, because it's such a large segment of the economy. But John, to your point, I mean, I think what's the stat, like over the past 18 months or something like that, like 60% of new mortgage originations have gone to variable rate mortgages, right? So and so these people, even up until like 2 weeks ago, were still getting variable rate mortgages at like 2.5%. Well, now they're at 3%. in July, we'll bump up another 50 basis points from the Bank of Canada. So now our variables at like what, 3.5%. Your fix is at 4.5%. Like, so like everyone's like, you know, keep in mind, like the Bank of Canada's just started raising their rates. Most of the housing market has not really yet actually been subject to the higher rates. Like a lot of people hold rate holds for 90 days. And so we've only been the market's only been correcting for 3 months. It's been 3 months, and most of the market's been actually on the old rates. And so what happens, like, you know, we talk about the 12 to 18 month lag on monetary policy. It's going to take time. I mean, you think about all these alternative loans, private loans that we'll have to renew in, let's say, 6, 7, 8 months from now at basically a doubling of rates. Again, I just don't think, like, these rates haven't even really filtered through into the housing market other than the psychological impact, in my opinion.
Yeah, I agree.
And that's what many prominent economists are also noting, the fact that it's already hitting housing prices. And mortgage costs are going to increase. I think David McDonald of the Center for Policy Alternatives mentioned what both of you touched upon, that, you know, the bank has an imperfect tool here. They can't really affect the gas and food situations, which have a lot to do with other factors, such as the war in Ukraine. And yet now they have one part of the economy, which, as Steve noted, is so important, especially in Canada, really being impacted. So it seems like it's like they're, you know, I have an image in my mind of a rock climber kind of stuck in a really bad place, like miming their next moves, but not committing to it. You know, and that's what we're hearing from the bank. We've heard them sort of suggest they might go up to 3%, but then we've also heard them suggest that they may not if the housing market continues to be impacted so strongly. So to be fair to you, Steve, you can't be faulted for not being able to see what even the bank is having trouble seeing right now.
Well, yeah, no, I'd love to just touch on that, because I think it's also important to look at. So even if we get to, let's say, 2.5, even 3%, like the market's predicting, like the question then becomes, like, how long do rates hold there? Are we cutting rates next year? I think that's like another thing to sort of keep in mind, right? Like, it's more like, I think some of the argument is like, oh, we're going to get to rates back to 3%. And they're going to, like, that's going to be the new normal. Like, let's see, because like I said, I just look at it. I'm only looking at this from a housing market perspective, because I think, like, housing basically, again, is the economy. That I just look at it and say, okay, like, what's happening in the housing market? And I think the underlying dynamics, as John and I are discussing, are probably a lot worse than most of these economists or even people at the Bank of Canada are actually aware of what's happening.
Mm-hmm. And you've already touched on this, both of you, very nicely. But John, just to as we move off this point, you mentioned in your recent report that there are 3 factors likely for the price drops. Interest rates rising is one. The amount of purchases that were actually pulled forward during the COVID period. And Steve, you also touched a bit on that, talking about, you know, the irrational prices you were seeing in February. Throughout the COVID period, we've seen some really interesting bump ups when we didn't expect them. So that might be some demand being pulled forward. And then the third, John, you said, was buyer anxiety. And both of you are saying that's probably being factored into the market right now, but the full impact of interest rates and other things actually being felt may not be seen yet. So
yeah, I agree 100% with Steve. Like, all of the demand right now is still at March's interest rates. People aren't buying homes and paying 4.5% on their mortgage. They're still paying 2.5 or 3. So, you know, come September or August, we're going to see what the market's like and what the demand's like when fixed rates are 4.5% and variable rates are obviously higher after another rate hike. So we'll see what that's like.
Yeah, John, I would actually be kind of curious to hear your thoughts on how much you're seeing some of the, because like I've got, like, you know, like a bunch of buyer clients that we're working with right now, and everybody's kind of trying to, like, figure out the market. And it even feels like realtors are like, I don't know, what should we list this thing at? Like, is it going to go multiples, or is it going to sit there for 4 weeks and they're going to do 2 price reductions? Like, it seems like there's like this price discovery moment.
Yeah.
And because I'm seeing basically like houses that are going, like, I think too low. Like, it's clear that someone was in like panic mode and was like, I need to move this house. And then you're still seeing like the odd house go like multiple offers, and like for like a price like too high, like, you know, whatever, $100,000 above the asking price. You're like, well, who paid for that? Like, do they not know the market is changing or has changed? And so I'm wondering like how much of that is just like people that like have that rate hold in place, and like maybe they already sold like their condo, and so they're like, I need a place, my rate hold expires in 6 weeks. I gotta win this multiple offer. We like this house. We're gonna be here for the next 10 years, and they're overpaying.
Yeah, no, 100%. I think that's still happening, and we're still even in Toronto, we're still getting bidding wars on some homes with 5, 6, 7, 8 offers. And some prices, you're right, we look at it and we're like, who the heck paid that? But listen, in some cases the home's unique, so you can say, okay, fine, like there's something unique about it or the lot. But I agree. I mean, in other cases, I mean, it's a combination. Maybe people bought and they're not following the market, or maybe their agent's not following the market. Man, the number of agents who messaged me on Twitter over the past month and a half who were trying to argue with me that the market's not slowing down, it's just an opinion. And I'm like, you people are crazy. Like, it was an opinion in February, I will say, right? It's not an opinion anymore. It's like, it's facts, right? And they still cannot grasp it. So
but that's what the show is for.
Yeah, exactly.
I forget what I was going to say. I had something to add there, but just on sort of the price discovery thing. Yeah, it seems like a lot of the market's still kind of figuring it out right now.
Yeah, for sure.
And we're not seeing like a flood of new listings, because I think everybody says, yeah, like if we look at, I mean, Greater Vancouver listings, for example. So we've talked about the decline in detached home prices, for example. I mean, new listings were actually down 14%, for single family homes. And in the Fraser Valley, where I just said volumes were cut by 50%. And month of inventory is growing, prices are declining. New listings were actually down 15% year over year. So nobody's like panicking, like, oh my God, flood the market, mortgage rates are going up, I can't afford this. Nobody's panicking from that angle. Everybody always expects that as soon as prices start declining, that people are just going to start dumping inventory onto the market. And I don't think we're seeing that.
No.
Yeah, very interesting and confusing times for sure. I just want to briefly touch on the Ontario election results before we go to reader questions. And so, John, I'll mainly direct this to you. Steve, very interested to hear your view. Have any as well. So the elections have just happened in Ontario, and for some reason, the words damp squib keep coming to my mind, although I'm not even entirely sure what that means. I don't think it's a Harry Potter thing, but the result was was as expected. Doug Ford leading to a very strong majority. The leaders of both opposition parties, the Liberal Party and the NDP, resigning. Now, John, I'm wondering what you think this election result says about housing, if anything. The housing came up, the housing affordability issues came up a bit during this campaign. I'm not sure it had the biggest impact on the elections. I'm just wondering about your views.
Yeah, I mean, it definitely did not. I mean, the PCs had probably the worst housing platform. I mean, when the Ontario Real Estate Association, it's headed by Tim Hudak, who is the former leader of the PCs, comes out and basically says the PCs have the worst housing platform. I mean, they have the worst housing platform. So they're not, they don't have a lot of plans to do very much on the supply side, on the demand side, on short-term rentals. It's kind of business as usual. I suspect if we start to see, they're probably going to be pushing supply in the suburbs. They're building the highway in the suburbs. They probably want to build more low-rise housing. But again, that's like a long plan. So I don't expect the current provincial government to do very much on the housing front over the next little while.
You kind of touched upon a feeling. I was recently on a very ill-advised drive throughout the GTA's inner and outer suburbs. Let's just say Tom Cruise has nothing on anyone looking for coveted IKEA patio furniture right now. It is mission impossible because of the supply shortages. So I found myself driving around and I was really kind of disoriented by how much housing you see across areas, even intensification along some corridors, some transit intensification. There is an incredible amount of housing being built across the GTA. I grew up in these areas and I could not recognize where I was at points. I wonder if in the back of our minds, more people than want to admit have this sense that Ford is going to let the builders just build. Mm-hmm. And as much as we know that supply side arguments can't solve everything, is there a bit of magical thinking? Do we kind of feel like, okay, maybe we'll just pave paradise and housing prices will come down. I wonder if Ford's success, in other words, does kind of, indicate maybe this latent belief that we have that supply side will save us.
I mean, it's all magical thinking. I mean, like at the end of the day, listen, the province is doing nothing to, I just posted about, short-term rentals, people basically tens of thousands of people buying up homes and converting them to mini hotels, like permanent mini hotels, or renting rental properties and converting hotels. This is something that they could obviously do to clamp down on, which would add tens of thousands of homes to our inventory for rental, permanent rental, or for buyers. They don't want to do that. So if they don't want to address the obvious bad things that they can relatively easily do, there's no chance that we're going to be able to do the more difficult task of actually doubling our housing completions in 10 years. I think it's unlikely. Again, I think it's a lot of magical thinking. I don't think the government really has any desire to do anything bold to clamp down on price acceleration in the housing market.
Who's going to build them?
Exactly. I know. I know. That's the problem.
That's a good topic for our next roundtable, because I saw some really great exchanges, John, on your Twitter, and I think Stevie chimed in on that note about the shortage of trades and whether anyone is really putting coherent policy proposals around actually getting any of this done. Mm-hmm. Awesome. So, Steve, do you have any other strong views about Ontario?
No, and I haven't followed. To be honest, I haven't followed your political space too closely. I just think a lot of it is noise, unfortunately. I think.
It is.
It turns out most Ontarians apparently didn't the record low turnout. So, sad state of affairs on that front. Okay, let's go to reader questions. This time we had a lot of Twitter questions. Invite everyone to keep sending in your questions for future segments as well. And let's start with Peter at the Twitter handles at Peter of Record. John, I think this is a good one for you. Is this correction we're seeing structural or cyclical? And what would make you change your opinion?
I'll start, but I want to hear what Steve has to say too. Just to start with that, just so people understand what Peter's asking, a cyclical correction is effectively kind of like what we saw in 2017, at least in the GTA. Short-lived, prices dip for a couple of years, but then we're kind of back to business as usual in short order, right? Versus structural is some longer lasting correction or kind of damage done to the economy. Housing market that lasts a lot longer. So if we think about the housing correction in the early 90s that lasted well over a decade, that's probably much more significant. So which way are we going? Man, it's so hard to tell, because I think it largely depends on the path of home prices. Like if we see prices fall 15-20% and then just kind of level off, I think we're not going to be too bad. But if we see a massive correction in the housing market, it's going to have massive financial repercussions to that, and it could probably last a lot longer than people hope. And I think that's the challenge. Like if we see 30+% price decline in the housing market, or 35, we're not recovering from that very easily. And I think people think we can, but there's no chance. Like if we think about our assets, what we own, imagine cutting the value of your home 35%. People have taken out HELOCs, they've done renovations, like there are massive risks. And I don't think the economy is recovering very easily from that. So I think it really depends on the path of home prices personally. I don't know what Steve I'm curious to hear what Steve thinks, but I think it depends on the future direction, I think, of the housing market personally.
Yeah, I think that I think it could be. It could easily be a 2 to 3 year correction, and then people forget that we've gone through periods, I think, in the 90s there, with home prices were flat for over 10 years. So, it's possible. I think, listen, if you bought at the peak in February, you could be sitting on that valuation for 10 years, easy. Particularly in some of the suburbs, right? If you bought at the peak in the suburbs, again, you could be sitting on that valuation for a long time, right? If you get it, let's say you get a 20% drawdown from the peak in February, and then, it takes a couple of years to recover from that, and prices kind of slowly trickle up higher. So again, for you to get sort of your value back, again, it could take some time. I think it's only structural depending on where interest rates ultimately sort of hold and stay. I would just like to remind people like how highly levered, not just like the Canadian housing market is, but really just like the global economy, right? I mean, look at like, the Fed's raised rates like what? Like the most important central banks raised rates 75 basis points. And like they just eviscerated like almost $10 trillion of wealth in like 3-4 months. So I just think that, I don't know. I still think we're in a low interest rate environment for prolonged. I still think inflation runs higher than the real interest rate for a relatively prolonged period of time.
So I think you're actually touching a bit on the next question from @FramedData, but I think it's worth posing it. And the question here is about, do you expect real house prices to return to 2019 levels? And I think they're referring here to pre-pandemic levels, so February 2020. And I think we've noted that prices would have to correct, John, I think your poll mentioned 35% for that to happen.
Exactly, to get back to February 2020.
Right.
I mean, I don't like, yeah.
Yeah, so if not, why not? Steve?
I don't think that much. No, I just think like that this becomes a systemic thing. I just think that central banks and policymakers have already shown us who they are, and that they tend to, right or wrong, they support asset holders. And so at some point, the pain will be too much that they'll have to reverse course. And like, I know people get all upset about that. And like, that's not free markets and blah, 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 blah. But like, I just think like it's still so early. Like, should the Bank of Canada be panicking right now and reversing course? No, it's been 3 months. We just started a housing correction. But as we start to drag on here, as this housing correction turns into 12 months, 18 months, like, and prices are down and people are, that's, I think, when they start to reverse course. So I don't see it getting back to those levels. Look, we still had record immigration in Q1 of 2022. And I still think we're going to be in a loose monetary policy regime, which is that, inflation couldn't go from 7 back down to 4. And interest rates can go to 3, back down to, let's say, 3%. You're still looking at like a real negative cost of borrowing. So I don't know. I just think policymakers have shown us time and time again that they support the housing market. And so I think there will be some pain here in the short term, but I think over the longer term, I just don't see it getting back to those levels.
And @FramedData has another question specifically about Toronto, John, which I thought was interesting. So he's wondering, or they are wondering about the difference in price declines between the suburbs and the core. And he's asking, you talked about a 15 to 20% decline in some suburban areas. Do you think the core is going to follow? In other words, is there just a lag in the premium markets?
Yeah, I personally don't think so. I think what's happening right here is that the suburban market significantly outpaced the downtown market over the past 2 years. Price growth was much higher. If prices rose 50% in the suburbs, maybe they only increased, say, 20% downtown. So, and I think what we're seeing now is, just the reverse of that. The higher you rise in the housing market, the harder you're probably going to fall usually. So I don't think we're going to see the same type of decline in the urban market as we are in the suburban market. That's just my instinct, but that's kind of what I would expect. And I don't know if Steve sees the same thing in the Vancouver, but that's what I would think.
Yeah, I just think like suburbs will correct, a lot more than, it is what it is, like the most desirable real estate. And like, people always talk about, foreign money in Vancouver and Toronto for that matter. Like the foreign money predominantly goes into like the city of Vancouver, right? Like they come in, they buy the luxury towers, they buy some of the nice real estate on the west side of Vancouver. Like they're not buying townhouses in Abbotsford and Langley. So I think that those markets become more vulnerable. And again, to the point of like rising interest rates and mortgage rates going up, like I always say, like, who does that impact the most, right? Like if you're buying a $4 million house on the west side of Vancouver, like chances are like you're not too concerned if the mortgage rate goes from 2.5% to 4%. You're probably buying with a huge down payment. You probably run a business. You're probably extremely highly wealthy individual. The people that rates impacting, when rates go from 2.5 to 4.5%, that impacts your blue collar worker, your 9 to 5. That's just squeezing into the townhouse market. That all of a sudden, their mortgage payments are up $500 a month, plus their fuel prices are up, plus their food prices. Those are the people I think that get squeezed, and I think those where you start to see probably more distressed sales in 12 or 18 months from now.
It's interesting you say townhouses, because I believe, John, that is one of the segments in the suburbs of Toronto that has taken the bigger hit.
Yeah, definitely.
Yeah, so there's similarities there. Okay, so we're keeping to our tradition, I think, of about 30 minutes for a chat. So I'm going to end with this last question. We had other great questions coming in. I think they would be perfect for, they relate to some of the future roundtable discussions we're going to be having. So fear not, if you haven't heard your question, keep sending them in, and we'll keep getting to them. The last one, Steve, I thought was good for you to take on. From @RealSalukan, why don't realtors ever advise prospective buyers to hold off buying as market conditions are worsening, and more price pullback is expected in coming years, given the rising interest rate expectations, and that the plunge will be fast and deep?
I love this question. So the role of realtors is not to predict markets. Nobody can predict markets successfully and consistently, right? Imagine if there's 14,000 realtors in Greater Vancouver. Imagine if 14,000 of them were tasked with helping clients time and predict markets. It would be an utter disaster. Your job is ultimately to educate people on current market conditions. There's certain times where I will evaluate a client's situation and say, well, based on your situation, you're in a secured rental, you're a first-time home buyer, and you can run the risk of taking the next 6 months to see if we can time the market. Now, because I want to take you back to, remember March, April, May of 2020 at the onset of the pandemic, every single person in Canada thought house prices were going to drop and crash, really. Record unemployment, and look what happened. We just went on the single largest bull market in history. CMHC, our own government agency. And so some people will be locked out of housing forever based on that call. So it's not your job to predict markets. These markets are not set by realtors. They're set by central bankers. They're set by global policy. Nobody can predict what inflation will be next year, where global interest rates will be next year. We can make educated guesses in the short term. But I think your job is to really educate clients on current market conditions, help them get the best deal in today's environment. Nobody can predict markets. I know the smartest people, some of the most respected realtors that I know in this Vancouver market here that have been doing this for 20 plus years, that the top producers, and I know some of them personally sold their houses in April of 2020, thinking they were the smart ones. And I think that was probably the right call at the time. And their house went up $1 million plus, and they're renting right now. So I know they'll be fine financially, but even the smartest people in the market, we can't predict. So and again, just not to go on a rant, but I never, I try to get smart. I remember telling a client once, so in 2016, the detached housing market in Vancouver was rolling over because we had just brought in that foreign buyers tax, right? And everyone's going to go, oh my God, foreign buyer tax. Foreigners were the only ones driving the market. Everybody panicked, nobody buy. So I remember telling people, I had one buyer, and I said, in 2016, the condo market's going to come down because, the single family housing market's already rolling over, and we just brought in a foreign buyers tax. Maybe you should wait. And then in 2017, the condo market went up 22%.
Oh.
So I don't think it's the job of realtors to be the predictors of markets, but it is to provide a valuable service of educating your clients and helping facilitate moves.
John, I'm going to just have you answer one last question because it touches on this as well. Mm-hmm. And as I ask you to respond to what Steve was saying as well. So it's from @DaveWatt1. Do you have personal evidence, as opposed to personal opinions of realtors not being honest with their clients about current market conditions? Because, it is a fair question, I think, to ask, because there is this sense that while Steve rightly points out that it is a hard thing to do in terms of, and not the realtor's job to predict markets.
Yeah.
Some consumers do wonder if realtors are advising them based on what they're seeing?
So, I mean, number one, I 100% agree with Steve. I mean, we're not in the prediction business. He's 100% right. The obvious call in March 2020 was to tell people not to buy a home. It was a stupid call. We had clients who bought, you know what I mean? Because they knew prices might go down a little bit, but they were buying for the long term. They didn't care. They made the right call. And I think that's kind of the market we're in right now. We don't know if prices are going to dip another 5, 10% or 15% or more. It's unpredictable. I mean, we don't know because we don't know what the market conditions are going to be. But to your question, I think it's a very valid one that the person asked. Yeah, you look online, you look on Twitter, and apparently TikTok is the place to see this. There are a lot of agents that don't understand the market, that are very bullish about the market. And listen, I do think there's something to just educating people. I mean, I think there's this balance between what is opinion and what is fact, right? And Steve and I can have our own opinion about the outlook of the market, which is fine. But we, when we're advising people, have to try to separate what we think might happen versus what's actually happening right now, because those are two completely different things, right? And I think that's where a lot of agents are, personally, a lot of them aren't doing that. I think part of it is because they just don't know. Like, you have a lot of agents like, oh, it's only 2 months of inventory. I read that that's still a seller's market, and it's just like they don't understand what's happening. They don't do a lot of sales, so they don't have a lot of listings, so they're not seeing what the showing volume is like. You know what I mean? If you only have 3 listings a year and your last one was 6 months ago, you're not going to know that they're like crickets. Like, some listings are getting like 3 showings a week. So, some agents, I think that's kind of part of the problem. And they're just, I don't want to say deliberately, they just don't understand what's going on in the market. So the information they're giving is, of course, very different from if you follow Steve and I, which, I mean, not that we're bearish, we're probably more just realistic. This is what's happening, right? So I do think it's a valid question that the person asked. I don't know, Steve.
It's like that old saying, it's always a good time to buy and sell real estate. Like, well, I mean, it's either a buyer's market or a seller's market. Like, it can't be both. So, I always say, like, if you're going to interview like a realtor to work for, you want to get their honest opinion. Just call them up and don't tell them if you're buying or selling. Just ask them what the current conditions are. Maybe that will help. So I don't know. That's kind of my thoughts. But John and I think are working towards, creating or trying to instill sort of a new way of approaching real estate. Because I think like the whole industry and sales industry is changing, right? Like, people are coming and seeking out information. Like, and I think like the way that you sell today is through content and through transparency and through an advisory approach, and not just like the hard sale, hard close. Because people have information today. They know, a lot of people know what's going on.
Yeah,
absolutely. They're looking for advice and context to help them make the decisions, not somebody telling you it's always the right time to buy.
Cheerleaders.
Well, that was great. I think that we've gone maybe a little bit over time, but I thought those were some great questions from our followers it's a very confusing time. It's funny. I have to write from a perspective of Move Smartly Editor's Chair, a wrap up to 2 years after we hosted a virtual conference in July 2020 on the COVID pandemic and the impact on the housing market. And I'm just reviewing all these views. And as Steve pointed out, just the real fear and the negativity and, oh my God, don't buy, buckle down. Just looking at the tape and how, very few people, if no one, saw what was about to happen. And I feel like we're in one of those moments again.
I think no one predicted this bull run aside from Steve Saretsky with his face-ripping rally tweet. I can't remember when that was. But
I balanced that out with my interest rate call, which is I'm eating my words on Scotiabank, so I'll own up to that one for now.
Well, to be fair, you were speaking in late November, and I think Scotia made their call in January, so I think they saw a bit more.
But they will be wrong on house prices. Let's add that.
Well, anyways, that was great, guys. I think we will leave it with you sharing your Twitter handles. And John, you're at Twitter at
John Pasalis.
And Steve?
At Steve Saretsky, not very creative, either of us.
It's actually easier to find that way. We're going to be doing this, as Steve mentioned, monthly. Please follow us at Move Smartly at our YouTube channel so you can see this conversation and future conversations as well. And as I mentioned to anyone who had a question that wasn't answered this round, we will definitely keep them and get to them in a future session.